The bank stress test results are out. We'll see if you guys are right. He's got the full results for us. Wilfie.
Hey, Kelly. Yes, so the Fed Vice Chair for Supervision, Randy Quarles, has said, quote, capital levels of the banks under severely adverse scenario are higher than the actual capital levels of large banks in the years leading up to the financial crisis. And this is despite a tough scenario and other factors that affected this year's test. The capital levels of the firms after the hypothetical severe global recession. This is reading through the quote again, so if we can move a little bit further down, and we'll continue. The point to make is that on average, the 35 banks tested CET1 ratios fell from 12.3% to 7.9% under that severely adverse scenario. And that's despite things getting harder this year from last year. The severely adverse scenario assumes GDP fall of 7.5%, unemployment rising to 10%, equities falling 65%, housing down 30%, and commercial real estate down 40%. There are some individual results to look at. All of the big six looking fairly comfortable. Goldman Sachs the lowest here, which was expected, and in part why they suspended their buyback earlier this quarter. The supplementary leverage ratios are also looking fairly comfortable for most of the banks. So they're all above the required minimums, which is the crucial thing. Morgan Stanley and Goldman Sachs getting a couple of questions on the call because they're quite close to their minimums, but they're above it. We don't get an outright pass or fail this week. That comes next week with the CCAR. And overall, Randy Quarles saying that the banking system seems robust, seems well capitalized, and the 35 banks tested do represent 80% of total capital in the banking system here in the U.S.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.